I see an article that says, oh, the recession is going to start this year. The recession is going to start early next year. And I'm like going, really? What are you looking at?
Hey, Jeremy Knight with the Knight Group, eXp Realty. Thanks for stopping by and checking out this video. As a real estate agent, it's my job to stay on top of what's going on in the market. That includes knowing what's going on in the economy. So every year, I do twice a year an economic update where I meet with an economist like David Tandy, who we're going to show later in this video, and look at the market trends, what's going on in the market, and what's going on in the economy. So we just met with David Tandy with TNT Title, and one of the other sponsors was Sarah Morris with Cinte Mortgage. Appreciate both of them taking their time. I've met with David Tandy in the past. He knows what's going on in the market. It seems like every time you turn on the news, we constantly hear the economy is going to crash. All of these things are happening, the trade wars, things like that. Well, David's going to talk to those things and kind of give some clarity on what's going on in our economy. And is a recession coming or is it not coming? You have to check it out. So thanks for stopping by and checking out this video. I'm going to leave it to David to kind of give some of this information. If you click to this time right here, you only want to hear about the Austin market and what's going on in Austin and the projections for Austin. Check out this time frame right here, and that way you can fast forward to that. Overall, the Austin market is going very strong. There's a lot of great indicators for that. I'm gonna let David talk about those things a little more. There you go. Oh, and remember, if you need to buy or sell a home in the Austin area, make sure to reach out to us. We'd love to help. We're a husband and wife team. We have a lot of designations and we really care about our clients. Make sure you subscribe to our YouTube channel, like, comment, share. We really appreciate your time. Go.
Let's start with where our country is as far as an expansion. We're in the longest expansion, 122, 123 months expansion. And when you look at the chart like this and see that that's the longest since 1900, the obvious thing that you do is you look at it and say, well, that must be as long as expansions can run, therefore there must be a recession around the corner. And so many people and so many people in the media are doing that they're looking at this and saying, well, that was a nice run, so I guess obviously we need to prepare for a recession. Problem is that recessions need to be triggered by something. There needs to be a cause for what the recession is. So the first thing to understand is that there is no time limit on economic expansions. Australia right now has gone for 28 years without a recession. Now, they're actually teetering on going into a recession now because of just some of the things that are going on a global basis, and we're going to look at that. We're going to talk about what's going on a global basis. But you see there's many countries that have gone for extended periods of time, and most of their expansions, for a lot of them, got cut short because of the Great Recession that started here and kind of flowed across the entire world. Or you would probably have some even longer, others that had equally longer time periods. So that's just one thing. The very first thing to remember is there's no time limit on an expansion. There needs to be a reason why it goes into recession. So let's look at this. Let's look at two different slides. The first one's going to be no recession soon because there's really no trigger. And let's look at some of the triggers that have gone on in the past. Rising inflation forces the Fed to raise Fed funds rate. Well, right now, inflation, actually, they're worried about it being not enough inflation. They want it to be not more than 2%, the Federal Reserve does, but they get nervous when it's too much below 2%. And core inflation will go above 2% for a little bit, and then it starts dropping back down. They would have assumed, and what has always happened in expansions in the past, is by the time you get to this point in an expansion, things overheat. Now, we have real estate overheated, the stock market overheats, some kind of asset bubble begins to be overvalued and overinflated, and that starts driving inflation up. So the Fed feels very comfortable with, well, our job now is to step in, we'll start raising the Fed funds rate, we'll keep raising it until we deal with the overheated market, the overheated assets. And many times in the past, they have stood on the brake long enough that they not only fixed that, they fixed inflation, but they also caused a recession. Or a recession was a natural consequence. Maybe that's too much to say that they caused it, but you can certainly read a lot that says that they've been too quick to stop inflation and work too hard to do it, and stood on the brakes so long that they unnecessarily caused a recession in the past. And I think they're sensitive to that now. You read more information today about what the Federal Reserve thinks, and they were very quick this time to stop raising the Fed funds rate. They were looking at inflation, they were looking at some of the global concerns, and they had announced that this year they were going to raise rates a couple of times. Maybe mid-year before they were saying maybe as many as 4 times in 2019, and then they're doing none of that. They actually wound up lowering Fed funds rate, which was utterly unpredicted. So no one would have seen that coming. Very odd to be having a booming economy and the Federal Reserve is lowering Fed funds rate. That's usually what they do to stimulate the economy. So what is the logic there, that they're trying to stimulate an already hot economy? So we're going to kind of try to get into some of that. Consumer confidence drives so much of our economy. Probably 70% of our entire economy is about people buying stuff. So when you see consumer confidence drop, then they're going to stop buying stuff. Has consumer confidence dropped? No, it has not. It's actually very high. Business confidence is at a 45-year high. Consumer confidence is at an 18-year high. Stock market corrections causes a drop in business and consumer confidence. Well, the stock market is basically where it was in January of 2018, and it hasn't triggered consumer confidence to drop. That's very unusual, and it indicates a more resilient economy and a more resilient consumer base. The consumers have gone through now 20 years of the Twitterverse and having everything 24-hour news cycle. And they're getting more immune, I think, my opinion. They're getting a little more immune to immediate bad news and responding to it. They're a lot more of look at the big picture. So when they do these consumer confidence surveys, they ask, you can dig down and see what the certain questions are. You dig down in the questions about, are you confident about your job, about your company, about getting a raise, about where you work, about jobs in general, companies in general. All those continue to be very positive answers up until this last one that we have. So consumer confidence surveys and business optimism surveys are very volatile. That can change in 1 month, but you just haven't seen anything yet. I don't see anything there that's a trigger. And I don't see how the stock market's corrections that they've had have spooked anyone and caused anything that would be a trigger for a recession. Bank insolvency, the whole 2007, banks weren't solvent enough. They're too big to fail. They did not have enough capital to take care of downturns. Banks are not in that position anymore. Banks have got strict stress tests on them. They have got plenty of capital. They have got lots of regulations to force them to have plenty of capital. The U.S. banking system is super strong. So we're not in danger of there being some kind of insolvency crisis, and we're also not in danger. I didn't really put this up here. I kind of dropped one of them off. One of them is that we're not writing mortgages that are going to go into foreclosure. Last time I checked, you all are doing a very good job of underwriting all these mortgages. You require good FICO scores. You require all the full documentation. You require proof that people can pay things back. You require debt to income ratios. All those were very good things to put in place to keep us from being in a position where we trigger a recession because we've got a big foreclosure bomb about to go off. There's no foreclosure bomb out there. Poor regulations, bad laws, all the things that caused the S&L crisis for those of us that were around at that time. That was a major mess. All of that has been cleaned up. Overbuilding has caused real estate gluts in the past. It's very hard to overbuild now. Builders would love to build more, and they can't get enough capital. They can't get enough lot inventories. They don't do their own development as much now. So there's controls and things in place to really keep that from happening, almost too much so. We don't have any inventory. Real estate realtors know that there's not enough inventory for resale because we haven't built enough of new homes to feed the future resale. Poorly underwritten, I did have that up there. So poorly underwritten mortgage loans. Oil price disruptions, oil price shocks and oil price disruptions. We have not much chance of having oil supply disruption, and we had a massive oil price shock, and it did not trigger a recession. So you kind of almost have to remove that one from the table of being a future trigger, just because things have gotten so much more diverse, and our economy is much more resilient for things like that. So these have all been past triggers, and I go through all those and go, which one of these is a trigger now? And I don't hardly see any of them. We're going to look at the next slide and say there are some things to be concerned about, but don't forget how many things have triggered ones in the past that are not there today. So I would at the very least say if there's a recession looming, it's going to be a relatively mild one. So the really big, deep recessions we've had have been because of some of these things like this. So that was the positive. Let's say, okay, what are the things that could cause a recession at some point? The next 9 to 22 months is kind of the average for when the yield curve inverts. Then 22 months later, on the average, you have a strong potential to see a recession. So in late May, the yield curve inverted. The long-term treasuries and bonds were paying less than what the short term was. So people are less confident in the long term, which implies they're worried about recession. And whenever we have seen that, and I'll skip to the next slide and then come back to this, we have seen, every time we have seen the yield curve invert, this is the 3-month treasury to the 10-year treasury. Anytime that has happened in the past, it's really only been a false flag, false indication one time, and eventually turned out to be right. But every time else, when it has done that, you do wind up seeing a recession. So I think you have to take that. It's not a cause, it's a red flag. It's an indicator of things. So if it doesn't cause, if there's not a recession looming right now, it's because this inversion is something different causing the inversion now. And I think there's actually some argument to make for that. We'll look at that in just a little bit. I'm going to come back to this right here. So yield curve is an indicator, but there are other indications to go along with, there are usually other indications to go along with the inverted yield curve, and most of those don't exist right now. Trade war drags down the world economy. That is definitely something that is new territory. I don't think any of us have ever seen this kind of a trade war. We've never seen this level of tariffs. You look at the trade wars, trade spats that we've had in the past, it's been for like 1 or 2 or 3 things. Soft lumber from Canada, champagne from France, something that is a short term, nothing that's going to impact the economy. These are a whole different ball game. So it's, frankly, I've done a lot of reading about it, and the opinions are all over the page because I don't think it's new territory. I don't think anybody really can say that they know because we haven't really experienced this. And we've never experienced it with this kind of interrelation. You look at our amount of our GDP is based on exports around 12%, but you look at the other countries, all of Europe area, the UK, France, Canada, Italy, they're all a third of their whole GDP is based on exports. You look at Germany, it's 47%. You start tinkering with that whole trade, all those trade relationships, it's going to throw countries like that into a recession. Germany is teetering on it, South Korea is teetering on it, and here's the reason why. They are so dedicated, they have so much dependence on that. But trade wars can end quickly. So if this were to wrap up quickly, or this were to come to an end and this gets resolved, my own personal prediction, you could wind up seeing an explosion in all these economies. But until that gets worked out, I think it's really anybody's call. At this point, I don't see how anybody could predict it. If this keeps going on and on, we just don't know how much. I think a lot of people would have predicted we would be much worse off now with the kind of tariffs that have been put in place. Again, showing, I think, how resilient and how good so many things are in place. Another concern for why we might be seeing a recession is we don't have near the cushion we used to have. During an expansion in the past, we might be up to a 5% GDP growth rate. This entire expansion, we've been doing good to get up to 3%. The idea of getting up to 4% is kind of like a distant memory at this point. We can hit it like 1/4 and that's about it. So the times of us being able to have a 3.5% to 5% in an expansion, which gives you a cushion. If you drop a 1%, if you have a 1% overall drop in your GDP growth rate, and you're already at 2.5%, you're now getting down close to not having a positive growth. Recession is defined as 2 consecutive quarters of negative GDP growth. Well, you're getting close to that. So that's scary to see that. This is kind of compounded by what's going on in the world. The world GDP has been slowing down. World manufacturing across the board has been slowing down, I think all due to a trade war going on. So I think that's, to me, the big wild card out of everything that's on here. And it's a wild card as an unknown. I can't even give you any really good prediction for it. But I think everyone's attention now is on what is really going on with that. What will be the impact? Where is it really headed to? And will we get a resolution to it? Particularly since China and the U.S. are the two biggest economies, and they just are. They truly impact every other economy on the world market. Housing affordability to me is something that is a very big concern. When you look at where median family incomes are and median home prices, at the end of the day, median home prices can't go up more than median family income. You all know that more than anybody does, the people who are lenders. You see that every single day. In markets where median home prices have far exceeded median family incomes, they have really severe affordability issues that at some point have to be corrected. If you look at the median family income, median home prices for the entire United States, prior to the Great Recession, we had opened up a pretty big gap. And prior to that, they were very much in sync. We really did not see home prices go up more than incomes since 1950s. Throughout all of that period of time, if you track it, there was a very tight correlation. Prior to the Great Recession, we wound up having a big gap open up where home prices were exceeding it. We hyper-fueled the real estate market, had a lot more activity, a lot more demand than we had supply, and home prices went up. Well, guess where we are right now? We have a lot more demand than we have supply, this time for different reasons, this time because we didn't build enough. The home prices have really started exceeding what family income is more than they were prior to the recession. I don't have a chart for it on this slide deck, but I have run the numbers to look at it, and it's scary to see what's happened. Not necessarily so true here in Austin. Median family income is around $92,000. Median home price around $300,000. That's 3 times what you make. That's about a really rough measure of what is affordable, what you can purchase. So in Austin, we actually come out on an affordability index really well. Part of that's driven because tech salaries have driven up our median family income more than other markets. So that's has made up for it if you use that measure. But if you look across the United States, this has really opened up to be a big gap. And I just don't see how that can keep going forever. At some point, there has to be a correction for that. That, to me, would be something that would, maybe not a recession, but I could definitely see where it would cause some kind of slowdown where housing is just not affordable for so many different segments of the population. The big thing that I always look at and that I always talk about is just how much debt we're incurring. We've funded most of this expansion on debt. That's a true statement. We have funded a very big buildup in our military, and we funded a whole lot of not balancing our budget. I mean, right now they're talking about we could actually have a $1 trillion deficit, which only fuels our growing debt. We're at $22 trillion on our debt. Unfunded liabilities, things that we have obligations for, but we don't necessarily have funding for, is now at $124 trillion. Our military is more than the next 7 countries combined. Those are all obligations. It's hard to unwind. That's hard to support. We have a massive economy that can support all that. It has supported all that debt up till now. I don't know when the tipping point gets that you get to a point where it can't continue to support it and you start having to see some challenges to it. Those, to me, are the things that are weighing on our economy, that are causing challenges in the background or directly. The big one is the trade war. That if it gets resolved, I think you see a lot of optimism and a lot of growth that happens from it. The last thing I had on there is recession bias. I think economists are killing themselves to be the one to predict the next recession. So if they want to get print, they want to get talked about, they start talking about, well, here's the thing that's going to be that causes the recession, and here's when it's going to start. So they have their name attached to it. We talked the inverted yield curve. When I talk about that, Normally you'll hear the 3-month treasury compared to the 10-year, but you got to be careful when you're reading articles. Sometimes they're comparing the 1-year treasury to the 10-year, or the 5 to the 10, or the 1 to the 20. So there's really probably 15 different yield curves that you could easily see being talked about when you're seeing something talked about in the press. You have to be kind of careful about which one they're talking about, and not all of them are inverted. Not all of them are showing a sign. So it's kind of how long, how deep that inversion is, and how long it goes on. And I think this time you really have to look at why is it inverted. People across the board are concerned because this is such new territory. The trade war is just wild how many products have got tariffs on them now. It's not something that's sustainable. It's something that has to come to an end at some point, one way or the other. So it's a little scary. Here's a 1-year to 10-year comparison. It's still even inverted for that. This one is just takes subtracts the two. So if you subtract, if the short term is higher than the long term, then that's going to wind up showing you a negative, which is where this graph is showing. Let's talk a little more about the U.S. economy. There's the very volatile, but if you look at the long-term trend for the consumer confidence, recessions occur whenever that index gets down into the 60s and the 50s. It's up around 135 right now as an index. That's a very, very high rating. That shows you only get there whenever there's a lot of positive responses whenever they're talking to them. That's up through July. I checked last night after Donna pinged me. I checked last night just to update everything, and the August one isn't. The numbers for that are not released yet. So it has definitely kind of leveled off for the last 4 or 5 months, but it's leveled off because I don't know that it gets higher than that. This is right before this one that occurred. This level of index was right before the tech bust, which the stock market was very guilty of a lot of irrational exuberance. And there was some artificialness built into that. This is all based on very solid economic. Companies are all doing well. There is not a lot of free credit flooding the market. There's at least mortgage credit. So there's a lot of things that are not artificial about this growth. So I don't know that the index ever gets higher than this. I don't think this index was legitimate. I think that was artificial. I think anything above 120 is just rock solid as far as what consumer confidence is. There's 2 different surveys. Both of them are doing very well. I think those are very good indicators. When that starts dropping, that is definitely a time to be concerned. This is their graph. They're up to 15% GDP growth rate. I mean, we can't even imagine that, what that would be like. We don't think we've ever been at 15% GDP growth rate since we've had measurements. We've been as high as 10% before, but way back in the past. So the most on this graph that we have back to the 1990s, we would get up to 5%. Here's 4.25%. The different lines go up to, this is the line that goes over to the 4%. It's a bit of a complicated graph. But here's China. They got up by very artificial means. They literally built airports that no one ever used. They built cities that no one ever occupied. So lots of steel, lots of concrete, lots of jobs to really stimulate their economy. And it worked. It got it up to 15%. It dropped down. They got it back up to 15%. We plummeted the recession. They got it back up to 12%. They're now down to about 7%, 6.8% or something, and they don't really expect that they can't keep doing that. Their economy has now grown and changed and evolved to the point that they can't manipulate that anymore to get it up to 15% growth. So they're sitting there at 7%, not being happy. Their 7% feels like our 2% or our 1%. We're at nothing to be too proud of. We can't get above 3%. We got above it twice, maybe arguably 4 times barely, but we've averaged less than that. So neither one of these countries need to be in a trade war. We need to be figuring out how you work together, because we are connected. We are very, very connected. The supply chains are so connected, it's unbelievable. Here is another graph showing up. This is an index showing how much easier it has gotten for us to be able to trade with each other. the cost of trading each other continues to plummet. That is what that is showing. It's more efficient. The cost of trade has dropped over this long period of time. And we have little hiccups along the way. We fight with Canada over softwood sometimes. We've had a period of time we got mad at Japan because they were buying everything over here. We've fought over bananas. We've not had this. This is a whole nother realm. And I've tried to find some comparisons that really show the extent of these tariffs first in the past, and there's just not much data out there. But you can just do some looking at it and just know that it's been a long time since we've done something this aggressive and been this involved in trying to have tariffs go back and forth. It's not helping either country, and it's not something that we really have any history to go on. So I would have to guess that you're going to see some kind of resolution of this in the near future. And I think that bodes really well if we do. Let's talk about the construction for just a minute. We talked about it's hard to overbuild. Here's the U.S. population, very, very steady growth. We're up to 330 million. Here's the kind of construction we were doing. We were up to both single family and multifamily combined. We're up to 2.25 million units. Here's the recession. We dropped down to 500,000 units. Here's where we've now built back up to. Our population didn't change. We kept adding people. We have this really interesting experiment. Let's let our population keep growing. Let's not build enough places for them to live. And let's see what happens. And what happens is this. You have a big demand, you have a low supply, and prices get out of whack, where we now have a major affordability crisis across the entire nation because of this right here. You can't keep having more population, more people coming in, more births over deaths, and don't build someplace for them to live and not wind up with some major problems. Yes? Yeah, I'll let you raise your hand. I'm sorry.
No. I'm just freaking out.
Well, this is true across the entire population, the entire geography of the United States. It's very true in Austin. Resales agents will ask me, so when is this inventory issue going to get fixed? It's like never. And you're going to have an inventory problem for your foreseeable career because this isn't getting fixed in Austin either. Austin did build 16,000 single family and 18 in 17 it built about 17,000 in 18,000 in last year, and this year we're probably going to be on track to do 18, maybe 19,000, and that's great. That's enough construction for our 1 year's population growth. We're going to do 55,000 new residents, and we're going to build 17,000, 18,000 homes. We're going to build about 8,000 multifamily, and that's about enough to house the 2.4 people that will go into those units. We didn't address any of the gap, any of the deficit that we went through for 7 or 8 years where we weren't building anything. Sometimes we weren't building but 8,000 total units. And that's a deficit we're carrying forward and we're not addressing in any way. And frankly, I think it could get a lot worse because all of the job announcements that have happened over the last 12 to 18 months with Apple, with Google, with all of that, those are all hiring that's going to happen over the next 3 years. That's got to drive more population. They are relocating people. They are not going to find those employees here in Austin. They are having to relocate them here. That's going to increase your population growth. We're not going to build enough for it. So we're going to be in that same, your inventory issues are going to get worse, is what's going to happen. U.S. unemployment rate, every time I do this presentation, I show the slide. It's an unbelievable slide to me. We're down at 3.7% unemployment now. We have more people, we have more job openings in this country than we have unemployed persons. We have more job openings in Austin than we have unemployed persons. Pretty dramatic change. Really nothing like that's existed in ever, really. Even this period of time was, again, right before the tech bust, and I think to some degree that was artificial. So you have to go all the way back to the Vietnam War before you see a time when we had this kind of unemployment in this country. There's our job creation. July numbers just came out, 164,000. This is very solid job production, but it is less than we did in 2018. So this is, I think, averages out about 180,000 jobs. We were in the 200, 210 range, 210,000 jobs. Still creating 180,000 jobs in a month, every single month average is pretty impressive, pretty dramatic. It's a very long spell of expansion of us creating lots and lots of jobs, and all of them very solid jobs, very, very good jobs. Good jobs in the sense of they're based on good economic fundamentals. Look at this slide later, it just shows you the fastest growing jobs, which are all tech jobs. That's for 2018, 2019 projected. The top paying jobs, again, lots and lots of either health sciences, technology jobs kind of dominate everything. This is, you look at, I talk to my kids, and if you got grandkids, this is a fantastic slide to go over with them and say, and explain and understand. This is where it's all going to be. It's all going to be STEM based. It's going to be health services, or it's going to be some kind of general services, personal level services. That's where the jobs are. Other jobs are going to get replaced by robotics and artificial intelligence, and that is just a clear trend of what is going on. This literally gives you the numbers. Here's job openings, 7.3 million job openings in this country. Unfilled job openings that are not filled. There's need people to fill those jobs right now. And we have 6 million people that are unemployed in the country. That's about as healthy an economy as you can. I see an article that says, the recession is going to start this year. The recession is going to start early next year. And I'm like going, really? What are you looking at? The entire country is employed. These 6 million people don't have the skills to fill the jobs, or they would have filled them. That's the issue. What we have is a pretty significant skills gap going on both in the city, a dramatic one in the city, and a pretty dramatic one on the country, on the overall country. All these 6 million people generally are the ones that need to be retrained into skills that fit the jobs that are out there. They're not; those are most of them pretty high demand jobs, high skilled level jobs. That's the reason they haven't been filled. Let's look at what just kind of drive home the point about, to me, the resilience of what our economy is. This has been adjusted for inflation, so it actually adjusted for inflation. We got up to a high of $163. We dropped down to a low of $35. That's a pretty massive drop. Anytime in the past, that would have devastated Texas. Texas would have just stopped on a dime. Did we stop on a dime? Not at all. We are so much more of a diverse economy now than we were back in the 80s and the 90s, whenever we were a very energy state and we would have a drop in oil price. And I lived in Houston during this period of time, and this was not a fun time. This was a very different environment to be in. So we're running around $55, I think $58 is what it was this week. Dollars. That's in the past they predicted that price would have not been enough for them to be able to profitably go explore oil. They're profitably exploring oil. The entire technology, the entire industry has changed so much that that is a doable price for them. If the price starts going up, the Texas energy economy will boom even more. So I just think it just shows the resilience of our country and the resilience of Texas, and just what a nice state to live in, that we're doing 40% of all the oil production in the United States out of Texas. Texas is 40% of all oil production. The U.S. is the largest producer of oil and gas in the world now. We produce so much more now oil out of the Permian Basin. We've now taken over. We produce more than Saudi Arabia. We produce more than Russia. Pretty dramatic change in all that. And normally that actually oversupply would have crashed the oil price. And what's been happening is OPEC and Russia and several countries have curtailed their production to keep the price up, propping the price up. So we kind of wind up with a double win. We don't control the price. We don't control our production. So it's really left to OPEC to control that price and keep the price up, and that's exactly what they've been doing. Indicators of the strong economy for 2019 for Austin, I'd go ahead and say 2020 also at this point. We're going to have more population growth. We've had very, very steady population growth for 4 decades. We're now at a 2.1, 2.2 million population. That population is going to go to 5 million over the next 25 to 30 years. And it's going to do its fair share of that in this next 1 to 2 to 3 years. A lot of it because you haven't even seen what a hot job market is. you're going to see an even hotter job market over the next 2 years as unless these companies scale back what their announcements are. But if they can do what they've announced, it is a dramatic challenge for us to fill those jobs. We've had in the past, over this whole decade, we've been at 3 to 4% 3 to 4% job growth. That has really dropped down. Growth rate for the trailing 12 months through July was 2.3%. We did 24,000 jobs created in the last 12 months instead of the 35 to 40,000. Why is that? If it's such a hot job market, why is job creation slowing down? There's no one to hire. Where labor pool has shrunk to such a small amount, our unemployment rate is running at 2.7%. That just does not create a pool. There's only 33,000 people in this whole 2 million population that are looking for a job, that are unemployed looking for a job. 33,000. There's 50,000 job openings. So where is Apple going to hire? They're going to have to relocate people. They will not be able to hire 15,000 people. They will have to relocate them. They just don't exist here in this market. New home construction, I already talked about that. We're ranked number 1 in 2018 on a per capita basis as far as building permits. We'll probably do the same thing again in 2019. Again, I think we'll be at 19,000 permits. Rising incomes have been steadily rising. 5th fastest growing growth rate for rising incomes. I think this is an awesome thing to be able to look at, that we're doing loans that are good quality loans. That's true across the board. Those are all very, very positive things for what is in store for Austin. The biggest one is company relocations. We're going to talk about that in just a minute. There's high-tech salaries. You know, we're really constantly increasing the percentage of the total workforce in this city is becoming more and more of a tech workforce. So we've gone from 10% to 12 to 14. The last numbers we have are 15, almost 16% of all the jobs are tech related. You're working for a tech company of some kind. You may not be a programmer, but you're working for a tech company. And when you break those jobs out, that's right at $120,000 for your average salary. So that's unusual for most markets. Most markets are at, I think Dallas is like 6% of their total workforce is a tech workforce. So we're a very unusual. There's about, 3-4 major tech areas. So Apple's going to be hiring from San Francisco, Seattle area, New York area, the Research Triangle area, and Boston area, and moving those people here. So that's where they're going to find the people to move them here. Cupertino, they're moving a lot of people out of there to come here. So it's a tremendous commitment that they've made, to this market. This is just what have been the announcements over the last 12 to 18 months. I won't go through all of these. I'm actually going to show another slide that just lists how many of them are 1 million square feet now. But Apple's announcements, Google announcements, U.S. Army Home for the Futures Command, that's a huge thing. It's only 500 employees, 400 of them are civilians, 100 are military, but it says so much. It says that this is the place where we're going to take our $30 billion budget for this one initiative to drive change through the entire Army. HEB, you mentioned earlier, they've got their innovation lab here. So does Walmart have their innovation lab here. What's an innovation lab? What do they do? They get in there and they innovate, whatever that means. It's the future of their company. That's the future of where these companies are. They're basing it on, brain labs that are being located here in Austin. Oracle is a great, great success story. They did so well with their first phase 1. They're doubling down. They're doubling the size of their operation and doubling their staff because everything they did worked so well for their company. That says a lot. So let's skip forward and look at, I can remember, this really dates me, I can remember when we only had 15 million square feet of office space in Austin. This is 15 companies that take up 15 million square feet, of which 1, 2, 3, 4, 5, 6, 7, I'll count this one 8 and this one 9 are at or almost at 1 million square feet. When you talk about Amazon, God, I didn't manage to omit Amazon from this list. Amazon should be on this list because they are way up there. They're definitely in the 500,000. I need to update the list. If you look at what Google is, did you realize that Google is at a 1.46 million square feet now?
Wow.
Apple's at 1.42. They're going to go do 3 million square feet. They're already leasing 1 million for two. Those Indeed's now over 1 million square feet. The person trying to hire all these people to fill all these jobs. Pretty dramatic. Very, very good tenants. Lots of construction to be done. Lots of jobs to be filled. That's what's going to be going on over the next 2 to 3 years. We've been at full employment, that's the blue line, for almost 5 years now. We're down to 2.7% unemployment rate. This is a very healthy economy. This is a very hot economy. I don't know what this is. This is insanity. I mean, this is really tough. And you look at Texas, when the oil price did that big drop, unemployment rate for Houston just still got up to 5.5%. That's not even that unhealthy at all. That's actually a small, blip in the road. So they definitely had unemployment, but for the overall Texas, it's amazing to see what has happened over this whole stretch of time. And 2.7 is really, I think, it's hard on an economy. It's really, what this means at full employment, it's supposed to be what the feds and the economists say is that at that rate, you've got anything below that, you're going to start having salary inflation. So if you want to be at full employment without having excess or having too much salary inflation, that would be around 4.5% to 5%. Some say maybe 5.5% even. Well, if that's true, we should be having a whole lot more salary inflation at this point than we are actually experiencing. We definitely are experiencing it, but for our whole country, we should be seeing rising wages way more than what we are. And there's a whole lot of studies about why is that not happening? Why is inflation not going up more just because of salaries with this low of inflation? And it's a very different economy than it has been in the past. It's a much more efficient economy. Our productivity has increased. It keeps increasing, and everyone keeps thinking it's going to flatten out, and you can't keep increasing your productivity. And our whole nation has increased its productivity pretty dramatically throughout all this. And that's one of the reasons it's held it down. This is some interesting numbers. These are out of LinkedIn. When people go in and they change their profile, and they say, I was in San Francisco, I'm now in Austin. Well, that tracks that as a move, and Austin comes up number 1 out of that. You kind of look at what the other cities are. Denver, number 2, number 3, Charlotte. And then you look at where did they move from, the top cities where people have moved from to Austin. Top one, San Francisco, Houston, New York City. If you want to see where the top ones are moving out of, it's Odessa, moving from Austin to a place. It's Odessa, it's Denver, and Portland, the ones that they move.
Glad
where
to
they
see the
move from.
Aggies are all going to take over.
Yep. We kind of talked about this already. We're at 24,000 job creation, and we used to be up here all the time. We used to be in the top 5, certainly in the top 10, and we were at the 3.5% to 4%. In fact, you used to have the top 3 were in the 4, even 5%, and no one's in the 4% anymore. So across the board, the entire country, job growth has slowed down. The job growth rates have slowed down across the entire country because there's no labor pool for them to draw from anywhere. So they're all having trouble filling jobs, and the job postings just keep increasing, and we don't have a labor pool to fill it. It makes a really good argument that we need to radically reorganize and restructure our immigration so that we can get workers in. That's what fuels, that's what's going to take care of me in my old age, is we have a youthful labor pool that is paying taxes and paying for all us old guys. And if you don't have enough workers coming in, you got some countries you can go around and look at and see what that looks like. Japan's a really interesting study. What does it look like when you don't have your labor pool completely ages out and retires, and there's no one behind you? There's no labor pool to be the workers. And they're struggling tremendously with that. Actually, China is too. So we've been a country of immigration that actually reinfuses that labor pool with a youthful immigrant labor pool, and it's actually doing well. We actually have a very strong immigration. You want to guess how many people we naturalize every year? 750,000 people that we naturalize every year. So we have a very active one. It just needs to be more. We need to actually work at finding ways of having a way of having a stronger immigration. Anytime you see someone saying immigrants are coming to this country and taking jobs, it's like, no, they're not. There are no jobs to take. We've already taken all those jobs. Freddie Mac interest rates, no one predicted this. Is there anyone in this room that predicted this? I didn't predict this. I actually went on record when it hit 4% going, you need to go refinance right now. It's never going to get any lower than this. Went and tore that blog up. No one has any idea that this is going to happen and understands even why it is. What I think as agents you have to really realize is you swing 100 basis points, you've changed the buying power by 11 to 12%. So you got a $400,000 house, they can now either afford $50,000 more or $50,000 less of a house when you swing 100 basis points. And that's in a pretty short time period that it has swung more than 100 basis points. So talking about uncharted territory, I truly believe anything below 4% could have only been done by the government fueling artificial incentives to get it down to that level. And we're not doing the quantitative easing right now, so I'm not sure what drove it down to this. 10-year treasuries have dropped. I guess that's what's driving it, and I guess it's instability in the international market that's dropped that down. So if that's the case, I guess you're going to see interest rates down low for quite a while, because until this instability is resolved, 10-year treasuries are going to be impacted by that. So pretty wild and crazy to see it at that point. Talk about something that gives the single snapshot that talks about how healthy Austin is. This is the sum of all goods and services. This still hasn't, not having to use 2016 and 17 numbers because the BEA has still not updated these numbers. But for 1 year or for 5 years rankings, we're number 2 as far as our GDP. We're at a 6.9% GDP. It'd be great for the country to be at 6.9%. We're really the gold standard when it comes to a diverse, healthy economy that's diversified, that's growing well in all areas. I threw in one slide just predicting what is going to be the 2019, 2020, and it's really pretty much the same. We're a very, very healthy economy. We're the best job market out there. We have companies looking at us stronger than they've ever looked at us. We've seen all the announcements. There's other companies doing the same thing, going, well, if Google's here and Facebook's here, what do they know we don't know? Why are we not looking here too? So you see, I think it's a pretty good chance you'll see more conversations about it. Our big challenge is going to be traffic and our infrastructure, just trying to provide all that.